Hello, everyone. Hope everybody is doing great. Before we get into our quarter four market commentary, we first wanted to say that our thoughts and prayers are with the people of Israel and those impacted by the heinous acts of the Hamas. At a time like this, with so much human loss and suffering, it seems trite to discuss the market and the economy, but there is a lot going on, and we want to ensure that we keep everybody informed with everything going on as it relates to the market and the economy. So as we head into fall season, our quarter four, as well as going into 2024 outlook, is overall positive. We thought the best way to cover what's going on currently in the markets and the economy is to frame it with a couple questions. So the first question, with rates being so high, or with rates as high as they are, why haven't we gone into a recession yet? Everybody's been crying recession for the past really 18 months, but we haven't gone into one just yet. Why is that? Well, it's really two things, among other, but two main things. First, the U.S. Consumer is overall financially healthy. Everybody took advantage of refinancing their mortgages back when mortgage rates were 2.5%, 3.5%. Everybody refinanced, locking in those low long-term rates. Now, even though rates have come up higher, it really hasn't impacted the overall debt holder that much. Again, it's created a strong U.S. consumer and continue to be strong going into the rest of the year. That's the consumer side. But businesses did the exact same thing. They locked in a lot of those low interest rates on their debt, allowing them to shore up their balance sheets, allow them to spend more on capital expenditures, new factories, new distribution centers, whatever it may be. But that's created a boom for the economy as well. And companies continue to outpace earning estimates. And we're already seeing it so far this quarter. They're starting to report quarter three earnings this week. And we're seeing a lot of positives, from that. Question number two. This is the million-dollar question. Is the Fed done raising rates? I think they're pretty close. They could already be done, and they're giving hints that they are already done. A lot of the Federal Reserve chairmen are saying that they're done. If they do another one, which we might see in the next month or so, it'll be 25 basis points, and then at that point, I think they'll be done. So the market is currently pricing in about a 25% chance of them doing one more 25 basis point hike. That's to be seen. But inflation's coming down overall. September numbers came out and it peaked a little bit more than expectations, but we are seeing some positives as we look deeper into the data. Core inflation, which excludes the more volatile food and energy from the index, has had a downward trajectory, which is a very positive sign, even though price of oil has come up, as most of you guys have seen over the past couple months. But we believe that their rate hiking cycle is coming to a close, and eventually, probably toward the end of 2024, they'll get back to their stated goal of 2% inflation. Again, that's what they want to have, 2% inflation within the next year or two. The third question, and this is really looking forward, what to do with, investments or cash on the sidelines, money markets. The third question is cash king right now? There's a lot of uncertainty, a lot of noise going on in the world today, in the news cycle and whatnot, but is cash king? So money markets right now, and our money market at Schwab is currently paying 5.25%. We can understand that a liquid cash-like investment paying 2.25% feels pretty darn good. But as investors, we need to take a step back and understand that markets don't idle for long, okay? And so while it can be beneficial for investors to hold cash or money markets for preservation reasons or for liquidity purposes, holding too much can lead to overall suboptimal results for longer term investors. Okay, investors could become stuck in cash if they wait too long. Hey, I'm going to wait until the market seems like it's more positive. Well, then the market does rebound, and okay, well, now I don't want to be a buyer when the market's up. I'm going to sit and hold. So it'll create a layer of, hey, not getting invested for the long term. So we're going to show a chart here in a second, but a lot of money market assets is actually bullish for the economy. So the chart I'm going to show you in a second, money market assets as of September 27th are at 5.6 trillion. That's the most of all time. Historically, as I mentioned, this is a bullish sign for stocks. Anytime money market balances reach a new all-time high, looking forward for the next 3 years, stocks drastically outperform money market balances, again, as depicted in this chart. Something to keep in mind. Another thing is the Fed is most likely, as we mentioned, done nearing their interest rate hikes. And so while many investors may plan to remain on the sidelines until they start cutting rates, which might be middle of 2024, maybe toward the end of 2024, that's a mistake overall. Again, we've gone through these rate hike cycles multiple times. The end of an interest rate hiking cycle actually creates a strong opportunity for investors to redeploy cash, to redeploy money market balances. Because this change happens quickly, investors attempting to try to time the market are going to be left with weaker returns. It's impossible to time the market perfectly. We actually looked back and looked at the asset class returns across the last 4 cycles after the Fed stopped hiking rates, not when they began cutting them, but when they stopped hiking rates in the last 4 times that they've done this. In the year following their rate hiking, them stopping the rate hikes, cash largely underperformed stocks, bonds, as well as overall balanced portfolios, drastically underperformed it. So again, the first interest rate cut has been on average 10 months after the final rate hike, which if they're done hiking them right now, we could see sometime mid next year that they're going to start cutting them. If that's the case. But investors who wait too long are going to risk missing out on these potential gains. We're going to show another chart, very interesting, but over the past really 70 years, we've looked at an investor who just was buy and hold in the S&P 500 since 1940 until now, what their average return is, compared to someone who perfectly timed each recession as well as getting back into the market. The results are staggering, but it's, as you see in the chart, they performed exactly the same. Moral of the story is, be a long-term investor. Do not try to time the market. In this chart, if you timed it perfectly, you would still yield the same results as if you were just buy and hold that entire time. So interest rates are likely to remain higher for longer. I think we're pretty confident in that. The Fed has been pretty adamant in saying that. And that might eventually impact the economy in a more meaningful way. We don't expect this path for growth and gains to be smooth by any means. There's a lot of news headlines, a lot of short-term headwinds, in our opinion. But overall, let's zoom out. Let's look at more macro perspective. We have strong labor fundamentals, huge productivity gains from automation. Obviously, the hot topic for everybody is AI. That's going to lead to some drastic productivity gains. Increased adoption of AI, not only for big businesses, but small businesses, which is going to be a boon for the economy. But we believe it's going to take a rather severe downturn for stocks to return to the depths of what they were in a bear market going back to 2022. We do expect that emerging evidence of a slowing economy will be accompanied by expectations for the Fed to back off their restrictive policy. So in other words, if we do see some market slowdown or some economic slowdown, the Federal Reserve will then in turn cut interest rates, which will be a boom for the stock market, because the stock market is tied not only to earnings, but also interest rates, okay? So if we see a cut in interest rates, stocks will do very well, especially the technology and consumer discretionary sectors. But all that being said, you can be confident we'll continue to monitor market and economic conditions as they change so quickly. We'll let you know if anything needs to be changed or addressed, in anyone's account. Most importantly, if you guys have questions about anything that we talked about today, we're always here to talk. We're available. Just reach out to us via email, phone call. We'd love to see you before year end. But if we don't talk to you or see you, we hope everybody enjoys their fall, enjoys their holiday season, and looking forward to seeing you in the new year. Thanks so much. Y'all take care.